Hello, and welcome to this emergency broadcast, the day after global trade in freefall. That's a big question mark. I'm Joy Macknight, Payments and Transaction Banking Editor at Trade Treasury Payments. And joining me today are experts in global trade. Dr. Rebecca Harding, who's CEO of the Center for Economic Security, and Gabby Reid, Head of Advisory at Pangea-Risk. Before we begin, I'll just give a quick introduction to Trade Treasury Payments. TTP is a media and data intelligence platform focused on the intersection of global trade, treasury, and payments, where policy, risk, and real-world business decisions collide. We bring together practitioners, policymakers, and market shapers through high-impact journalism, live briefings, and curated intelligence. Our mission is to navigate complexity, helping institutions and professionals stay ahead of geopolitical shifts, regulatory change, and systemic risks across markets. So TTP doesn't just report on what's happening, we spotlight how it affects trade flows, capital movement, and operational strategy on the ground. Whether it's sanctions, supply chains, or sovereign risk, TTP is a platform for clarity, context, and forward thinking in a fragmenting world. So we released the first magazine yesterday, it's exciting, which has 12 articles of great interest, including 2 that we'll be discussing today on this webinar. You can access the first edition on the website, which is tradetreasurypayments, all one word, .com. Today's webinar is addressing the questions everyone's asking. How will the recent protectionist tariffs and America First trade policies coming out of the US President Trump's administration impact global trade? And then also, really, are we seeing this trend towards deglobalization? So, Rebecca, in your recent article in TTP, you referred to Trump's Liberation Day as the end of the Bretton Woods and the global trade order. So can you briefly outline what this moment represents really for the global economic system?
So actually the article is called Liberation Day After, and the reason why is because in international relations there's a concept of the day after, where where the world recovers from whatever shock there's been, and it could be international terrorism, it could be the outbreak of a war. And what we're seeing here is actually the removal of the United States strategically from the international rules-based order. What that means is essentially it's moved over to a mercantilist model where deficits are everything. So I export more, you export less, I win, you lose. And this has been on the cards since 2017, 2018. It's not new. But so to some extent, it's a grey rhino. We should have been able to see this coming and do something about it. But everybody hoped that this was a negotiating tactic. And, markets have been swinging in a very volatile way because they thought it was a negotiating tactic. Then they realized it wasn't. Then Trump said, well, actually, it's only going to be 10% across the board. So, all of these things, it's created a huge amount of uncertainty. So we are dealing with the aftershocks of all of that. And it is effectively the United States saying, we don't agree with the way in which all of these institutions for international trade have worked. And now we need to recalibrate it on make America wealthy again. Because in President Trump's words, the country's been raped and pillaged and plundered by other countries, and that's a direct quote. So it's definitely the United States against the rest of the world, and recalibrating the way we have to think about international trade.
Excellent. Thanks for those opening comments. And Gabby, I was going to bring you in as well. So you write about protectionism shaping not just trade balances, but also diplomatic relationships. And Rebecca touched a little bit on that there. How does the current U.S. approach sort of differ from historical norms? And then why is this shift so consequential, especially for emerging markets?
Right. Well, thank you for the question, and also thank you to TTP for the opportunity to participate in the discussion. I'm sure it will be an interesting one. To your question, I think historically US trade policy was rooted in multilateralism and anchored in the Bretton Woods system, as Rebecca has described it. And this really involved participation. It involved shareholder investment in institutions like the IMF and the World Bank. And we saw this broad-based agreement approach really promote predictability, rule-based commerce, for example. what we're seeing now under the America First strategy is the Trump administration has really departed from this and is now, we see the US redefining its approach to international commerce by placing tariffs on the one hand, but also bilateral negotiations at the center of its strategy. So really, in doing so, we're not only seeing an effort by the Trump administration to protect domestic industries or reduce the US trade deficit, as Rebecca has said, but it's also using trade policy as a lever to secure non-trade related concessions from its international adversaries, but also from its international partners. And I think it's quite interesting from an emerging market perspective, because it really underpins a pattern in the changing trade relationships that's been in play for a while now. But perhaps that these latest developments really just cement the need for trade partner diversification, as trade relationships that were once guaranteed under these sort of multilateralism are now subject to realignment.
Excellent. And then Rebecca, I think it's interesting that a lot of Trump's rhetoric is really around, framing trade as a matter of national security. And obviously he's using what's being termed shock and awe tactics to reset global expectations. How do you think allies and adversaries are interpreting this new doctrine? And then also, you made the comment before about just, it's very uncertain, really, what direction we're traveling or what direction Trump is traveling.
So there's a mistake to see this as random. And it's an absolute mistake to see this as something that hasn't been planned. As I said before, there's a whole whether you agree with it or not, there's a whole document, a whole documentary series, if you like, on what Make America Great Again looks like. So, the Heritage Foundation and so on have all fed into this view. Now, how are we starting to react to all of this? Well, we know that things are going to break, and they're going to break further. And so at the moment, the biggest thing that has gone in all of this system is trust. So, and we can see that in international organizations like the World Trade Organization, IMF, World Bank. All of the multilateral banks will be thinking at the moment, does the US engage with what we're doing or not? And if they don't engage, or they decide to withdraw from those types of structures, then those structures that are actually the globalization structures rather than the Bretton Woods structures, because Bretton Woods was all about US dollar hegemony, they start to break down. So the $1 million question, $1 trillion question is, how are allies reacting to all of this? The allies were always going to be more affected by this. And that trust element has gone. So if you go into Europe, if you go to Japan, if you go anywhere, everybody is saying, we do not know the extent to which the United States is a friend or a foe. And President Trump has made it quite clear that in trade terms, he believes that we are actually looking at the friends being more damaging than the foes to some extent. Friends have been a challenge. He said that in his Liberation Day speech. So what he's done with all of this is he's saying to markets, I'm going to break things, get used to it. And because he is breaking things, allies are saying, okay, so we need to do this by ourselves. We need to make sure that we've got the resilience there in our own systems, and that's collective defence. It's collective economic defence. It's understanding redistribution of supply chains and everything. So it's huge. It couldn't be bigger.
Excellent. I have to say, as a Canadian, your comments hit very close to home.
Well, and Mr. Carney said the other day, Canada is going to fight. We are at war with America in an election campaign. That is really, really, really significant stuff to be saying, right? It's dangerous language.
And Gabby, you mentioned the using trade as a tool to extract non-trade related concessions. I was wondering if you could just go into a bit more detail, as you did in your article, actually, in terms of how that's playing out recently, specifically in Africa or the Gulf region.
Yeah, I think we are seeing trade policies being leveraged as a foreign policy tool. Even if we look at the earlier trade-related threats coming out of the Trump administration, these were really used to secure commitments on border security from Canada and from Mexico. We also saw, the NATO members face threats as a means to bolster proportionate European defense spending in the bloc. Denmark, Panama also faced tariff-based threats in response to what I would frame to be US geostrategic goals of increasing control over Greenland and the Panama Canal, respectively. And this has also been the case for emerging markets. I think the administration's earlier threats of, I think the term was 100% tariff on members from the BRICS bloc, for example, was in response to reports at the time that the bloc was exploring replacing the US dollar as a reserve currency. And this really signals the potential for these tariffs and threats of tariffs and this rhetoric to really have a punitive nature, be a punitive measure against countries such as the BRICS members. And perhaps, South Africa is a unique case study here. Since President Trump took office in January, diplomatic relations between the two countries have deteriorated. Now, that's not to say they haven't had their ups and downs over recent years. They definitely have. But at the moment, primary issues around South Africa's Expropriation Act, South Africa's case against Israel at the International Court of Justice, and even its economic ties with China and Iran are coming into play in terms of relationships and trade relationships between the US and South Africa. Now, should the tariff program be rolled out, and obviously we've got the 90-day delay in place, South Africa will face around 30% levy on its exports, in addition to the 10% base rate. Now, on its own, that's not necessarily a standout example. It's not necessarily the highest tariffs, and it's not necessarily at this point punitive. But at the same time, we've seen the South African government come out and say they will engage the US over these tariffs. But given this ongoing diplomatic rift and the context in which this conversation is taking place, I think it's fair to say that it's less likely that the Trump administration will make meaningful concessions, and South Africa might struggle to secure high-level meetings with US officials over the matter. And this will be, game-changing. US was South Africa's second largest trading partner. It accounts for around 8% of South African total exports. So this has the potential to be game-changing.
Excellent. And do you want to talk a little bit about the Gulf, or the Gulf Cooperation Council countries, and sort of if there's examples of this playing out within that region?
Well, what I think we see coming out of the GCC is a desire to leverage this as an opportunity, right? Where through this increased pressure coming from the US, what we're seeing is countries within Africa, Asia, the wider Middle East, and then even within Latin America, they're looking to shift their alliances. And perhaps it might be towards China, it might be towards, other states, but the Gulf states are a playing part here. And what we've seen specifically over the recent years is significant Gulf interest in investments in Africa, for example, and Gulf states are becoming a legitimate trade partner alternative for African governments in a potential pivot away from the US.
Excellent. And then, coming back to your comments earlier, Rebecca, do you think this, if this is truly the collapse of the international rules-based order, sort of what will replace it? And do you think that, sorry to interrupt, do you think that poorer economies will get caught in sort of that crosshairs of geoeconomic conflict that we're seeing?
So I think where we are is interesting. Collapse of an international rules-based order. The international rules-based order was actually something that we made up. The Americans said that they didn't agree with it. Emerging markets don't agree with it. That was quite clear at the Kazan summit. What is beginning to happen is that we are seeing a rise of, they're called in international relations the middle powers. That basically means India, it means Saudi Arabia, it means the United Arab Emirates. You're seeing countries like Turkey being able to leverage a large amount of power. We've seen that beginning to happen since Russia invaded Ukraine and since we started using sanctions against Russia. So this whole pattern of the weaponization of the global economy, again, it's not new. Now, what America has done is actually trigger that moment where with the whole economy, the whole economic system was on a hair trigger anyway. And what they've done is they've said, right, well, we don't agree with any of this. National security is mentioned 15 times in a page, in the pages of a 5-page document, which is trade policy. So this is definitely coercive. Now, how do you cope as an emerging market? How do you cope? Well, you're going to look to where some of the deals are easier. And I think that inevitably means that there's going to be a separation out of trade into two geoeconomic zones. Basically, there's going to be one that's going to be much more China centric and another that's going to be US centric. That's been happening anyway for a long period of time. It's how quickly that happens and what the consequences are for replacing one set of dependencies with another. But we have alternative payment systems, for example, the SIP system from China. What that's doing is it's actually creating a lot of very important, very difficult strategic conversations for financial institutions as well as for emerging markets, because there aren't the strings attached to Chinese debt that there are likely to be attached to American debt or even European debt. So it's a difficult time.
All right. And then, Gabby, obviously there's been huge efforts around the African continental free trade area and regional integration. And like this seems to be accelerating because of, partly in response to the US unpredictability, let's say. Do you see these as temporary hedges or long-term strategic shifts? And then again, what's the role of specifically the GCC investment here?
Yeah, I think I would absolutely echo what Rebecca's been saying, is that, this acceleration of, well, let's call it an acceleration of regional integration, perhaps exemplified by the African Continental Free Trade Area, really does represent a longer term strategic transformation rather than being a pure transient response to, US unpredictability today. The Africa Free Trade Agreement is really driving significant momentum in intra-Africa trade. Intra-Africa trade itself grew about 192 billion in 2023. So we really are seeing a deepening of economic integration, and it's a deliberate move by African countries to reduce dependency on, perhaps, as we see today, increasingly unpredictable external partners. Now, alongside this, diversification is evident already in emerging trade patterns, right? So if we look at China, India, they account for around 23% of Africa's merchandise exports. If we compare that to the 90s, that was sitting at around 8%. So this has been taking place over decades now, and it is showing that sort of swing to other blocks. At the same time, to your point around the Gulf states, and also to Rebecca's points around the middle powers, United Arab Emirates, Saudi Arabia, Qatar, and even Turkey, they have cumulatively invested over $100 billion in Africa over the past decade. And 2023 was a sort of standout year. I mean, these states were involved in over 73 FDI investment projects on the continent, collectively worth over $53 billion. So really, it is showing a commitment to the continent. And these investments themselves, they sort of span quite a wide range of sectors. We're seeing investment in energy, including renewables. We're seeing investment in ports, logistics, agribusiness. And these funds are really reinforcing Africa's infrastructural development. And then at the same time, it's really strengthening new trade corridors. And I think that this is, in general, if we sort of zoom out from Africa for a moment, it's pushing South cooperation as well. And this is reflecting a shift away from a reliance on perhaps traditional Western frameworks to what I would describe as a more mixed global trade landscape. And we're seeing, for example, new trade flows that are specifically those involving China that run parallel and are separate to US involvement. Again, if we make a comparison using Africa as a case study, US-Africa trade stood at around 67 billion in 2023. China's two-way trade in Africa the same year was around 280 billion. So really that shift has already taken place. And non-energy trade, as an interesting example, between the UAE and Africa has also grown. I think it was around 20 billion, perhaps 10 years ago. It's now sitting at 60 billion. So really these alternative trade flows are strengthening. And for African countries, I think they're better positioned to negotiate terms that are perhaps more reflective of the economic value that they can bring to these agreements.
Excellent. And then, Rebecca, you've previously said that the world really faces a cliff edge in global trade. What do you mean by that? And then what does this mean practically for transaction banks and trade financiers navigating sudden shifts in supply chains?
So the reason why I say this is a cliff edge is this. What President Trump has done is use what I would call rational expectations model of saying to the world, we're going to change things, get used to it. What that means is that there is no way back from here. Things are going to change. They have to change because the US is doing what it's doing at the moment. So that gives us a cliff edge. That says, right, here we are. Things are going to change. What do we do with all of this? Supply chains might adapt, but as an economist, I have to say it can take several years for supply chains to adapt. That's where the inflationary pressures come from. And between now and these, let's call them songlet uplands that we have in 2 or 3 years' time, when everything has adjusted and all of that manufacturing capability has shifted around the world. And as Gabrielle says, the trade with China has increased, intra-regional trade has increased. That takes time. And so there are always going to be opportunities out there, of course, but the problem is it takes time to adjust, and it takes time, and it becomes more expensive and more uncertain. And that's what Trade and Treasury is dealing with at the moment. It's that uncertainty. How does this land? And back in the day, I used to teach undergraduate economics, and I used to say, actually, the problem for organisations is when they don't know what's going to happen. If they think something might happen, then it's a risk and they can insure against it. If they actually don't know what's going to happen, then that causes problems because they can't formulate strategies. And it's that very uncertain environment that everybody's operating in. So that's where we are. And so it will slow things down. It will make things more difficult, and it will make things more expensive.
Okay, and then obviously tariffs are driving inflation and foreign exchange volatility. What are the implications for capital flows and then also the currency markets? And what should corporate treasurers and banks be thinking about when they think about exposure management and risk management?
So I think I would refer back to what I said about the separation out of the global system at the moment, because you have got a different payment system waiting in the wings. You have got the SIP system. That's been quite explicitly the case since October last year, but it's been there for longer than that. It does payments as well. Now, the temptation is going to be for large organisations to look at their exposure in the United States. I mean, President Trump, as you will know, even had a pop at Canadian banks a couple of weeks ago because he said, well, they're not letting US banks compete fairly. All of this level playing field type argument is going to come back. We haven't seen service sector trade hit yet. So how does that affect capital markets? How does that affect capital allocations? Everybody is going to go, wait a minute, what's the risk of secondary tariffs? So for example, am I exposed to Venezuela at all? How am I going to be involved with Russia in the future? What's the policy there? All of these uncertainties will mean that treasurers will be very, very cautious in how they allocate. And then the US dollar. So at the beginning, everybody thought that the US dollar would strengthen. The tariff policies should be strengthening the US dollar. I mean, in pure economic terms, that's what should be happening. But the problem is they're not, because of all of this uncertainty. And everybody is now questioning whether or not, in international rules-based order terms, this is the end of Bretton Woods, because it's the end of US dollar hegemony. And that's the $1 trillion question, the $33 trillion trade question. Is this the end of dominance of the US dollar in international trade? And technology has been moving very fast. We've got alternative central bank digital currencies in China. Europe's been thinking about these things. It's a morass of uncertainty, and that will make treasurers very, very cautious at the moment.
Excellent. And obviously the other big question is really around debt sustainability. And when I had interviews with Ajay Banga at the World Bank a couple of years ago, obviously that was brought up, and that's been something that they've been discussing, and the IMF as well. As the dollar strengthens, Gabby, what do you think are the key vulnerabilities across frontier and emerging markets, and what kind of fiscal or sovereign risk should institutions be pricing in now?
Yeah, and I think, it's a sort of a two-part answer, really, because we've seen such volatility when it comes to the dollar, specifically in recent weeks. I think when we first saw the strengthening of the dollar at the start of the year, this had raised concerns around debt sustainability for several emerging and frontier markets. And this is because many of these economies obviously hold significant dollar-denominated debt. And when you take this and you combine it with inflationary pressures, rising global interest rates, simply put, the cost of servicing that debt just increases sharply. And so for many emerging markets, specifically those whose borrowing costs they can be up to 4 to 8 times higher than advanced economies. This means that even small increases in interest rates or small further appreciation of the dollar could really trigger painful fiscal readjustments. And I think that this environment forces governments to really review and implement austerity measures. And these can have secondary consequences around undermining social programs or really having an impact on long-term development strategies, which obviously are critical to several emerging markets' sort of long-term economic growth plans. And I think in general, reduced access to international financing, really being amplified by a more inward-looking US, has heightened the risk of defaults, or in the very least, heightened the risk of fiscal instability. And even as the dollar becomes more volatile, indeed, last week we saw a plunge in dollar demand off the back of the tariff regime announcements and sort of uncertainty, as Rebecca put it, within the markets, financial institutions will be sort of compelled to factor in heightened risk of defaults, abrupt fiscal adjustments in their pricing models. And I think that there's a general recognition now that there's an over-reliance perhaps on external financing mechanisms that could ultimately accelerate economic instability.
Excellent. All right. It's such a shame because we're coming to the end of the webinar, which I think we could talk forever actually on this topic. But I was just going to do a few wrap-up questions, but also if there's any questions from the audience, now is the time to put it into the chat and let us know. I was going to ask both of you, and maybe I'll start with Gabby first. In a world where globalization is retreating and regionalization is accelerating, as we've discussed, what practical steps can businesses and financial institutions, what should they be doing in order to stay resilient, actually, in this uncertain environment?
Yeah, I think it's about really seeing where opportunities might lie within this. From our perspective, we would say that geopolitical risk is coming to the equation, right? Are institutions really thinking through how geopolitical risk is going to impact their strategies, and are they accounting for that within their planning? So it's really around trying to understand the drivers of some of the changes we're seeing in the geopolitical picture, and then try and anticipate the consequences of change from those drivers. If you're sort of able to do that, be it through perhaps thinking through different scenarios or monitoring the more subtle shifts, it's monitoring things around rhetoric that are coming out of key administrations, I think you can sort of be front-footed in preparing for some of the shifts we're seeing, and then taking advantage of those shifts as they unfold.
Excellent. And Rebecca, what advice can you give?
So I think obviously managing risk and identifying opportunities, but the biggest thing here is actually the need for everyone to come together and create alternatives. And that means that banks, whom I've argued for a long time have been the foot soldiers in geopolitical conflict and geoeconomic conflict, because what they're doing is implementing the sanctions and tariff strategies that everybody has. They don't have any choice. They have to do this. So they're being used as foot soldiers. And somebody said to me, well, we need to get to the position where we can start using trade finance banks as tanks. We start, and that is a very worrying development. But the banks and the Treasury departments and everything have to realise that how they allocate their resources and the choices that they make are actually geostrategic now. So they need to have geostrategic strategies. They need to have that kind of framework, particularly in Europe, where there is so much that's up in the air at the moment. Reconfiguration of defence spending, reconfiguration of defence of the continent. It is a very, very serious moment in time, and the banks have to be right in the middle of those conversations. That's absolutely critical.
So, Rebecca, do you think that there's still a role for Europe in shaping sort of a new multilateral framework?
I think Europe has a responsibility to do it. I spend a lot of time in Europe. I spend a lot of time in the various institutions that are based in Brussels. And I think at the moment, what you are seeing is a degree of shock. Everybody's got post-traumatic stress disorder, but you are also seeing a very real sense in which Germany, France, the United Kingdom, Italy, the Netherlands, Belgium, we're all coming back together again to say, and particularly the Baltic states and also the Nordic states, because they are close to a Russian front line. We've talked about economics, but don't forget Europe and the European Union was set up to prevent war between its member states. Now got war on our borders. Our institutions aren't working. We can't trust the American umbrella anymore. We need the economic security and the institutional security in order to be able to fight that war. That's what Europe's dealing with at the moment. It has to find an alternative. It has no choice. And I think the phrase from Merz a couple of weeks ago, which is Germany's back. I mean, whatever you might think about that, that's good for Europe at the moment.
Excellent. And Gabby, I'll just ask one more question. You talk about the opportunities, but do you think, for example, Africa, but also other emerging markets can actually benefit from a diversification away from China and US-centric supply chains? Is that possible?
Yes, I do. I do sort of have an optimistic view of this, despite the headwinds generated by protectionist policies, despite these geopolitical uncertainties that will need to be dealt with. I mean, we can't just sort of put a pin in it and look elsewhere. But if they are sort of dealt with and they are managed appropriately, there is significant opportunity that lies beneath the surface for Africa, but I think for emerging markets in general. Diversification away from the US, diversification away from China-centric supply chains ultimately will foster greater economic resilience for emerging markets. And we've spoken a lot around the African Free Trade Agreement as potential to really push intra-Africa trade, but also in terms of establishing new economic corridors with the involvement of the GCC on the continent. But I think that this really drives the option of greater resilience and potentially regionalized alternative payment systems that can reduce transaction costs, reduce currency risks within these blocks, and ultimately sort of bolster trade dynamics. I also think that, moving away from Africa, obviously we've spoken at length about that. If we look at US-Asia trade volumes as these come under pressure, China is likely to look to deepen its engagement at a more regional level as a way to sort of cushion the impact of perhaps reduced access to US markets. And already in recent weeks, we've seen sort of the likes of China, Japan, South Korea sort of come together. They met for the sort of first time in 5 years to really look at the resumption of trilateral economic dialogue. There's sort of more renewed emphasis around the regional cooperation economic partnership within these jurisdictions. And I think that this also speaks to the potential for more regional-based opportunity off the back of some of these changes. Of course, the caveat there is, we'll want this to look at improving supply chain resilience, refined coordination for export controls, provided we don't necessarily see increased Chinese export flows ultimately oversaturate local markets.
Excellent. All right. Well, fantastic. I'm so sorry, but I'm afraid we're out of time, which is such a shame. But I'd just like to thank Rebecca and Gabby for all your really interesting comments and to thank our audience for watching.
Thank you so much.
Thank you.